Welcome to Achieve Wealth through value-add real estate investing. This is the show where the guru hype is banned and you get direct insights from commercial real estate operators. If you're a passive investor, this show can help you better understand investment opportunities. And if you're an active investor, the lessons from each episode can help you to become more effective in your own deals. Now, here's your host, investor and author, James Kandasamy.
Hi, this is James Kandasamy. Thank you for listening to this podcast. I appreciate you. I know I provide a lot of value through this podcast, and I want you to share it with your friends, with your families, and anybody else that you know that kind of benefit from listening to this kind of content. Go and share it through Facebook, through LinkedIn, through Twitter, through Instagram, or any other channels that you want to share it, because sharing is caring. Thank you. Let's go on with the show.
Hey audience and listeners, this is James Kandasamy from Achieve Wealth Through Value-Add Real Estate Investing podcast. Today I have a very special guest, David Lagat from Dallas area. And David must be the most interesting person that I've ever interviewed because he owns a lot of units on his own. It's almost 4,000 units he have done that is on his own. No syndication, right? So it's going to be very interesting because, where does a life of a syndicator ends up with, right? And I always think that first, of course, you do single family or you do multifamily on a syndication, and later on you go into, owning things yourself. But, so David is the end goal that some of the syndicators want to go, right? So even though he started recently doing syndication. So we can go a bit more detail into that. Hey, David, why not you say hi to our audience and give us a good introduction about yourself?
All right, James, thanks for having me on your podcast. Again, I'm David Lagat, based out of Dallas. I own a company called Bella Asset Management, and we are owner operators of Class B, C space in DFW and mostly Texas and the surrounding states. So we're in Oklahoma, New Mexico, Alabama, and Louisiana.
Yeah. So you are vertically integrated, right? You have property management, asset management, everything on your own, I guess.
Yes, we do have. We are vertically integrated. We have property management and construction in-house.
Yes. So that's crazy, right? I mean, so I want to go into that. How did you do that many units on your own? But let's go back to, your roots, right? So where did you get started in the US? When did you come to the US? And let's start from, where are you from originally?
I was born and raised in Kenya, went to a high school there. And then I came to the US about 25 years ago on a truck scholarship.
On a track scholarship?
On a truck scholarship. And went to college here in the Dallas area in TCU, actually in Fort Worth.
Got it.
And that's
so what do you do? Do you run? Do you jump? Or do you what
I ran long and middle distance.
Long and middle distance.
Yeah.
So I've heard about this, that people in Kenya, because they are in a high altitude, right? So
Right.
Their lungs are bigger, or the upper abdomen is bigger because they're high altitude. They always breathe much differently. Is that true? I mean, that makes them a much better runner.
I don't know. I mean, I think that's probably a myth, but
Okay.
it just, maybe you come from the highlands and maybe, we come from high altitude. Maybe that has something to do with it, but, there's some very high altitudes. Kathmandu, I think, is the tallest, the highest altitude that we do have, but I don't see I don't know that that's a factor, right?
Yeah, someone told me, because a lot of really good runners in the world, I mean, comes from Kenya, right? And so I don't know where did I read it, but they said usually because people live in Kenya, they are in high altitude and.
Yeah, I mean, that might have some truth to it because I live in the highlands of the Rift Valley, and so growing up, running up and down the hills with the goats and sheep. So maybe that has something to do with it. I just know that when I started running, it just clicked and I was fine.
Yeah, that's crazy, right? So So when you were in Kenya, I mean, did you ever thought about coming to the US, or how was your life there, and how did you, I mean, I know you, and eventually you got a track scholarship, right? But what was your childhood dream?
Most of my relatives actually run in Europe.
They're in
So
Europe?
yeah, Italy, maybe I think my uncle lived in Rome for a long time. So
Okay,
and also
okay.
all my cousins, they're either in Spain
Hmm.
or out running out there. And so when you're growing up, you're thinking, okay, that's where I'm going to end up. You're training. You're either going to go to Europe or those places, and then London.
You
And
mean they are runners who are in
yes,
Europe?
so they
Oh,
got
okay,
like contracts. Running is
okay.
just like football is here, where I come
Wow.
from. So
So you were part of that running family, right? Where everybody has that capabilities to
yeah, I think my
sport.
uncle, was the one that got everybody in that running, and then cousins and all that stuff. And
Hmm.
so,
Hmm.
but I
So
chose it.
so when you are small, you were thinking that okay, since everybody's running, the family is going to be a sports
I don't know
legacy.
that that's really what I was thinking. It's just I didn't know. I started running my last year of high school.
Oh, okay.
Yeah, so it wasn't like I've been running since. So I started running at that point because I was your passport out of the if you wanted to go to Europe, that's how you got there. If you wanted to
Hmm.
get go study overseas, that's how you're able to do it.
So how did you choose the US?
Actually, I had scholarships to go to university in London, Finland, and also, but then in the US, I got like 6 or 7 scholarships. I talked to a guy. He's from my village. He went to school in Iowa State. And when I talked to him, he was like, hey, forget about Europe. You need to go to US, study, and then you'll have something to fall back in case the running career has a lifespan of
Yeah, it's a
maybe
lifespan.
5, 7 years, 10 years the most, right? So like, okay, after you're done with your running career, what are you gonna do? So and then you could get injured. So it's like you got to have a backup plan. And so he advised me, hey, you need to go to the USA. And then the second part becomes, you have this scholarship, University of Georgia, Iowa State, Oklahoma State, Texas, and all these schools. How do what school do you want to go? The only thing that we looked at, since I'd never been to the States, was, hey, which one doesn't have snow? Go to Texas. I didn't know anything about Texas. So it was
Yeah,
like,
I
go
don't like
here.
snow too.
Yeah, it was
I
like,
don't
hey,
mind
go to
I don't mind
Texas.
the once a year snow. That's it that we get in Texas. I mean, we get after
Yeah,
every few years we get 1 day snow per year. So that's
yeah.
all.
So he advised me, he was like, well, I went to Iowa State, and you know what? I wouldn't advise you to go there because he went to do his master's at University of Texas in Austin. And it was like, well, I was there for 2 years and I liked it there. So I think you should go to Texas. So that's what
Got
I
it.
decided to do.
Got it. Got it.
I
Got
came
it.
to
Okay,
TCU.
so you came on a scholarship here. You studied in a college, right? So you said
Mm-hmm.
TCU, right?
Well,
So you did TCU and you did what 4 year program? Is that right?
I did a 4-year program, got my business degree
Mm-hmm.
in accounting and finance.
Mm.
And then, back when I graduated, companies were coming on campus, right? Recruiting you on campus. So
Mm-hmm.
I got my job, several offers on my junior year, my third year of college. So, graduated from that, went and worked for JP Morgan
Got it. Got it.
right
Got it.
after my right after I graduated, and as a staff accountant.
Got it. Got it. So you did your program, you finished your degree, you got into a JP Morgan as a staff accountant, right? So
Yeah.
so what were you, I mean, so when you started working, what were your thought process? Were you like thinking that this is how my life is going to be, or what happened then?
One thing that I was telling myself is I don't think this is the be it and all, right? I didn't think that I don't think that I was built to work at the corporate job,
Why did you,
the structure.
why did that thought comes
The
to your mind?
structure, right? Because it's like you need to be here this time. It seems like your time is regular. This is when you go to lunch. This is when this is when you report in the morning. It's like structured.
Mm,
You have to be here a certain time.
mm,
And the other thing that I hated about it is if you had to go on vacation, like assume I wanted to go visit my family in Kenya or something like that. I had to make sure that how many, you get 2 weeks vacation, so but then on top of that, sometimes you take time off for personal reasons. So you have to budget your time off so that, you still have time to go visit family and all that stuff. So to me, at that point, you're starting to look at, there's got to be something better than this.
Okay.
Right.
So then how did you, what was the next step after you being an accountant? How did you get out from that life? Or did
So
you
I
go
was
to another?
looking, I read a lot. So one of the things that I thought about is, I know owning your own business is going to give you that freedom, time freedom to do, at least you can, take some time off if need be, right? So then you start researching what you would do. And then, I think around that time, about 2001, I got, the Rich Dad Poor Dad was coming out. So I think I read the Rich Dad Poor Dad at that time. And from that standpoint, I think after reading that, I figured I steered myself towards doing real estate while still at the bank, and looked for property and bought my first fourplex. Didn't know what I was doing, just after reading Poor Dad for a while. Ended up buying a fourplex. And that's how my real estate journey started.
Got it. So audience, you guys want to listen very carefully because we're going to transition on how did David buy, almost 4,000 units on his own without syndication, right? I mean, you may have listened to a lot of other podcasts, a lot of gurus out there talking about thousands of units, but all that is true syndication, right? And this is a true life. I mean, you started in the US on what year, David? 1990 something, right? 1996, right? If I'm not mistaken.
96.
So that's when you started studying, I guess, right?
Right.
And when did you start the real estate? When did you start buying your fourplex?
So I graduated in college 2000. Worked for a year at JP Morgan, and then I think I bought the first property, a fourplex, in 2001, February of 2001.
So 2001, right? So 2001 to right now 2020 is like almost 19 years.
19 years, yes.
So in 19 years, you're able to accumulate you've done like 4,000 units. So right now, I know you have like 2,500 units remaining, right? You already sold like 1,500 units, and the 2005 is all on your own, and you recently did some syndication with a couple of 700
so
units.
You take that back for one of the things that for 10 years, from 2001 to 2011, I didn't, that doesn't, I was doing single family homes and duplexes and all that. So for 10 years, no multifamily.
Okay. So yes, I want to catch that. So you did 10 years single family houses, right?
And duplexes, fourplexes, nothing that I would consider multifamily.
Got it. But the Robert Kiyosaki book doesn't talk about a lot of single family. I mean, they do talk about, buying assets that income producing and all that. But I presume they talk a lot about apartments, right? So
yeah, I think mostly what I got out of the book was the mindset, right? You read it about, assets, liabilities, and all that stuff. It changes how you look at things. That's really, I think it kind of changes your mindset is really what I got out of it.
Yeah, it's crazy, right? Sometimes when you're working, when you're studying, you don't get any of this knowledge anywhere in the school, right? So people don't talk about asset liability and how does the rich people have more assets, less liabilities, right? And that's what you want to accumulate and get your assets to pay your lifestyle, right? So that's crazy concepts. It's not crazy. It's a really good concept, but it's not taught anywhere in our education system, right? So, so before that, I want to go to one more question where when you moved from your accounting job to real estate in single family, right? When did you resign your job? What year was that?
14 years ago now. It's 2006.
Okay, so 2001 to 2006, you were doing single family home. And at that point,
2011. So, I kept doing, so what I did was when I was working.
But you resigned in 2006, right?
From the corporate job.
Correct. So, so 6 years of single family.
Yes.
And you resigned. Is it because you made so much money in single family or what happened?
I think at that point I had about over 50 single family homes. And I had come up with a plan where I was paying some off. So it had reached a point where the job was getting in the way of managing the single family, because I was self-managing with a handyman and whatnot.
So how did you go to that 50 units from 2001 to 2006, and then you resigned, right? So I want to go that 50 unit, because that's a cliff that you jump from being an employee to become a business owner, right? So
Right.
let's start from your first deal that you bought. 2001, you read Robert Kiyosaki, you bought a fourplex. You do not know what you're doing, right? But did you
So
know something after that later on?
yeah, so actually go back, 2001, I was, in 2000, you graduate out of college and you're thinking, okay, the next step is, hey, buy a house, buy a new car, you have a job, right?
Mm.
So while at that, I was researching what would be the next step. I have a job, whatever it is. I met an older guy, he had been doing real estate for 40 years at the time. He told me, hey, young man, if you ever want to be somebody in America, buy real estate, right? So, and then I took that to heart. I went to the library, I'm reading it, and they were like, okay, do not buy a house where you're going to live in fast. Buy an investment property. So what I did was I bought a fourplex using an FHA loan, moved into one side of the 4 units. It was closer to my job, closer to DFW airport. Was able to get a very low down payment because it was FHA loan. I got the deposits. I closed in the middle of the month, so I got the deposit and the rent for that month to be credited to me at closing. So I ended up not having to bring so much to closing. Moved to one side of it, rented out the rest, and I stayed there for a year. I think that's what is required. And then I moved out, did the same thing, moved to another house, bought it with, a bank loan, whatever it is, stayed however long they wanted you to stay, and then I would just keep moving. But as time went, I started building equity, right? You're buying them, at that time, 2001, you buy houses, $50,000, $60,000, $70,000 that are maybe what, $200,000, $300,000 now. And with that, I also started going to real estate meetups and all that. And I got hooked up with wholesalers. I didn't market for the houses. Because I had a full-time job, right? So I got into the mailing list for wholesalers, and they will send me deals, and I'll just pick one, give them the assignment fee, I would buy the property, and that's how I was able to accumulate properties over time.
Got it. So that's very interesting. So you did one house at a time. The first was fourplex, and that's what we call as a house hacking, right? Where
Right.
you buy a fourplex and you stay in one, and you get FHA loan for the entire.
That's how I got started.
Yeah, correct. So people always sometimes they argue, right? I mean, even a lot of people say that, oh, that's okay. He did it when market was down, and he ride the wave. Do you think the same thing can be done today?
I'll tell you something. Back then in 2001, I talked to a couple of brokers. I talked to a couple of people that have been doing real estate. And guess what they were telling me? They were like, oh, real estate market is saturated now. If you had bought in 1990, if you had bought in 1991, there's always people that are going to say, 20 years ago was better than today. I guarantee you 20 years from today, somebody was hoping they bought property in 2020.
2020, exactly.
Right? Because, so back then I got those kind of, I don't know,
comments,
negative comments. And even one of the real estate agents that was selling me the property was like, and guess how I found the property that I bought, the first property? Out of a newspaper. Back then they had, you go to a Star Telegram, which is a newspaper here in Fort Worth. On Sundays, that's how I, would go into that and call real estate agents out of it. And then I would drive to go look at the properties. And, a couple of agents that I called, they showed me the fourplex. I knew what I wanted. I wanted a fourplex. And some of them was like, you are late to the party. You should have been buying a while back. But I didn't care at that point. I just want to get my feet wet. So I paid full price, paid whatever they were asking. I just wanted to get in.
Very interesting. I mean, even when I was starting up, I bought my first 45 units, even my single family, everybody say the same thing, right? People said, oh, it's too expensive. Prices have gone up. Like what they're saying right now, right? So the point I'm trying to make to audience and listeners, if you think that you missed the boat, right. I mean, I'm not saying you're probably right. If you think like that, yes. But if you think that you haven't missed and, you should buy it. The best time to buy real estate is actually yesterday, right? So
Right.
you have to buy, keep on buying if it makes sense, and keep on buying, because real estate in general goes up over the time, right? And it's a brick and mortar, so it's not going to go anywhere.
Right.
So yeah, that's what I want to make the point, saying that, it was hard time during that time too. You didn't ride the wave, and you were not like lucky.
Yeah,
Kind of
and
thing, right?
it's not that I had a huge pile of cash to put down on these houses, right? So it's like the only way that I knew how was to move in to get a lower down payment. That was the only way. If you moved in, instead of doing 20% down, you do 10% down. Or I think my first property, the down payment was like 3 or 5% FHA loan.
Yeah, FHA loan right now, right? So I'm selling one of my house right now, and the seller is putting only $5,000. That's like $170,000.
Exactly.
700, and then they are buy. I'm just thinking, wow, with 5% down, they can buy an entire house, right? So
Right.
and so I think what you did was something that not many people do, where they do house hacking. A lot of people think that. A lot of people doesn't even know that option available, right? They just said, oh, I want to buy another rental house which looks like my house, right? And they don't really see the cash flow. They don't see the tenants paying the
I'll
other
tell you
half
what,
of it,
on my
right?
first property, the
Mm-hmm.
fourplex,
Mm-hmm.
my profit every month, if everybody paid, was $100.
Oh,
So if
really?
something breaks, so for a while, my job was supporting my investments, right? Working at the bank and was supporting the investment, because sometimes it wasn't cash flowing, AC goes out or something like that. But I had that motivation and drive, that feeling of ownership. You own this, that pride of ownership, was one thing that I was so excited to own the first property, that I didn't mind paying for it to own it, right? Like, meaning adding
right.
additional money. You say I need the property to pay for itself, but at the beginning, I'll say the first couple of months after I moved out, I was paying to own the property. Then the property was not paying for itself.
Got it. So it was not like huge cash flow, but
It wasn't a huge cash flow, but I got a pop with the equity in the back end. That's how it really, catapulted me to buy more.
so when you were owning it and was cash flowing very little, I mean, did you think that you made a mistake, or you were okay?
No, I was so excited to own the property. I didn't, I thought, I knew the value were going to go up, but was I certain about it? No. But my goal at the time was, I'm going to double the principal, keep paying more on the principal, and then maybe in 15, 20 years, I'll have it paid off. That was really, what I was looking at. So I didn't look at, oh, this is a terrible thing. It should be paying for itself. It should be paying me. I had my job to do that.
Yeah. I mean, I know you're a CPA, right? So you must have calculated all the principal paid out.
Yeah, so I calculated and figured, okay, how many houses do I need to, how many years is going to take me to pay this house if I added, another $500 every month, if I added another 1,000. So my goal was to pay it off as quickly as I could.
Yeah, I did the same when I first looked at my single family. I looked at like, okay, cash flowing, because I was looking at deals in Austin. It was like 100,000, like 5-6 years ago, which is really cheap compared to now, probably 200,000-300,000, right? So, I know the cash flow probably like 3 or 4%, and that's like very minimal repair maintenance. But if you look at the equity pay down,
right,
someone else is paying your equity, right? So someone else is paying your mortgage, so your equity is growing, right? So that, plus when you sell, you get money as well, right? So you make like at least 9% cash on cash, right? So which is a really good return, right? So assuming like people like you and I, we didn't know real estate at that time, and we see this real estate, wow, it's like that's like a gold mine, right? So right. So I mean, I'm an immigrant, you are an immigrant. Do you think that the immigrant mindset helped you in thinking that, oh, I want to really make this a successful business?
I think it has something to do with it, and I don't think it's about immigrant. It's just about being able to see the opportunities. I think it's like I told a friend, right? Like we go back to Africa a while back, right? Our tech friends there, and when they go there, they get excited about all the wildlife, but when I lived there, it didn't interest me, right? Same thing here. I think people that live here, they
take for
they don't
granted.
see they're not able to, they get lost in the forest, right? There's so many opportunities that people don't know which one to I remember asking myself one day, what am I going to do here? And everywhere I saw, there was an opportunity to make money and be successful. I even thought, you can buy cars and sell cars and make money. You can do, there's so many opportunities for business that I was like, when I landed into real estate, it was just one of so many things that I looked into.
Got it. Yeah, I tried many businesses on my own too. I tried a website business. I tried a math education business,
Right.
and I tried playing stocks as well. But real estate is where it was really slow and steady, and I can understand it well. We can control it, and we
Yeah,
can make the
I'll
money.
tell you what though.
Hmm.
I started with the stocks around '97, where everybody, their grandma, and their dog was putting their money. People were pulling money. I remember my college friends would take money from credit cards and they put in the stock market and it doubles the next day. I remember I took the money, the few little money that I had, put in the stock market. By 2001, I think there was like right even before the right before the 9/11. There was a correction there and it basically wiped me out. So I'm glad that happened because I started looking at other things because I thought I was going to work for JP Morgan and then I'm going to be, stock trade myself to wealth, right? And then day trade is really what I was doing. And so I'm glad, I think I invested 5,000. It went down to like, less than $2,000. I got out and that's what got me to start thinking about what else could I do.
Yeah,
And
that's
that's how I
interesting.
end up with real estate.
Yeah. I mean, I like to do, I don't know, I don't call myself a day trader in stock, but I just like to keep on looking at stock because it moves every time, right? And nowadays you
Right.
have the phone, on iPhone you can just keep on seeing moving, right? And
Yeah.
because of that, it controls your life because now you're looking at it every
Exactly.
day.
When I was doing that day trading, it's like one day you have mood swings, like the stock market, right?
Yeah.
It goes up, you're so happy, excited, and then the next day you're like, you're like, something bad happened,
Yeah. So I don't like the not having peace in my life when I did stocks. So I said, okay, forget about stocks. That's for people who want long term, who are able to not look at stocks all the time, I guess, right? So it was not
Right.
for me. So let's go into 2006 and then where you moved to full time, right? From your accounting, from being an accountant to full time.
Mhm.
And what was your thought process when you moved from being an accountant to full time real estate investor? Why did you resign your full time job?
Because what I would do, James, is, I would take calls like, you have answering. So I would take calls. I think back then we had, we had people, right? You used to have that people.
Yeah,
That
pager.
the pager, what you call it.
Yes, we
Yeah.
have pager. Yes.
Yeah, you got a pager. And then what I would do is I'll look at those, like during my lunch break, I'll go to the garage and I would make phone calls on my lunch break and all that. It got into, as you add more property, you get
Because
more
you're like
calls.
50 houses, right? You're like
Yeah,
50
now you
houses.
got, maybe it was close. It was like 40 or maybe close to 50. I think I ramped up right after I left JP Morgan. But, it got into the way because now when I go home in the evening, I didn't have time for family, kid, or anything like that because now you have to go check, if, tenant call, they have to do, they have a service call and you need to stop by, maybe meet a maintenance, a contractor there and,
So
something
you
like
didn't
that.
use a third party property management. You were managing it yourself?
Yeah, I mean, at the beginning, it wasn't because single family homes, once you have somebody in there, they're long term and it wasn't really.
They don't really disturb you, right?
Yeah,
So,
they don't, they didn't, wasn't really that, they were not, it was not a daily occurrence.
got it.
Yeah, so so kind of managed it myself. In the middle there, I had a property management company take over, but it just wasn't any different.
Got it. Yeah, I mean, we had 13 houses and we thought that was a lot of work, right? So, but you're right. Well, once you have a resident inside there, you don't really disturb. Once in a while, you get call.
Yeah, you get a call.
Right. But you had 50 houses, so it becomes very painful, right? So when you resigned, did you ever thought that, hey, I've studied so much as accountant, I came to this country. Did you think all that goes to waste, or do you think, okay, I don't care, I'm making more money in real estate?
Actually, when I resigned, I told myself, okay, this is, I resigned when my profit, or you call it from the cash flow, surpassed my income from the job, right?
Got it.
At that point, I was like, okay, what if I put all this time to buy more properties? That's when I started thinking, what if I put, doubled up on the time that I'm, spending at the corporate job, buying more houses? What would it look like? So really, it was more of an experimental thing. And I tell you this, I resigned, and actually, so I resigned, but didn't resign because they were giving out, what do you call it? They were giving out
the separation packages.
Yes, they were giving out separate. It's like it was like voluntary, right?
Yeah,
They say,
voluntary.
okay,
voluntary.
if you, I think they were downsizing or whatever it is. They're like, okay, you either move to Boston or you take a severance pay.
Severance pay. Yeah.
They were not letting you. I don't know. It was kind of weird. They were not laying off, but they were giving us, option to move to Boston or take a severance pay. And so I took the severance pay, and then they were still paying you, and you still got an employment. So I was like, I'll take this and test how it feels.
Got
so
it.
I took,
so you got a big payday, I guess, right? From the
yes,
company.
and then I just took 6 months out of it. And tell you what, the first 60 days, I was so bored out of my mind. I was so bored because I didn't, you have all these hours. What are you gonna do? Usually you're used to getting about 6. You hit on the traffic. I live like about an hour away from my job in North Dallas, right?
Mm-hmm.
So then, now I started sleeping in until 9 o'clock, 10 o'clock, I'm used to waking up at 6. You start getting lazy, and I was like, what else can I do? I went back to work for Bank of America. So I went out there, and it didn't last very long. After 6 months, I went back, worked there for, I don't think it lasted that long, 60 days. And, I missed my freedom. So I quit, and then just got into real estate. I was like, I'm not going back. I'm going to do this full time. And that was it.
Okay. So you had a structured life, and then you're doing real estate halfway through, right? I mean, you're doing it as a part-time, but you are so busy. And then when you go full-time into real estate, it becomes too boring.
Yeah, because then you have these houses, right? It's not like they're calling you every day.
Yeah.
And when they call me, really, back then I have a pickup truck. I go to Home Depot. I meet a maintenance guy, pay for the stuff. And that was as far as I can. And then my office was at McDonald's or Starbucks. Like I would meet tenants, sometimes sign leases at Starbucks. And that would be it.
We do that too.
Yeah, where's the closest Starbucks or McDonald's to that house? We meet there, we sign contracts, and that's how I did business back then. And then, but the one thing that changed after I came back from working with Bank of America is I got into buying more properties. The way I did that was I hooked up with more wholesalers. I got like with home investors, and then at that point I started doubling up, and I would buy like 4 houses a month.
Okay, so I want to go a bit more deeper into that, because I think that's something that everyone want to know, right? So the first house was a 4-plex. Mm-hmm. So how did you move from the 4-plex to 50 houses at very high level? What was your strategy? Is it like you were buying distressed house and you're refinancing it so that you get next money, or
so what was the strategy back in 2001, there was a VA homes for sale. There was foreclosure. So the same guy, remember I told you about a guy that I met that had been a broker for 40 years. Mm-hmm. He dealt with only VA homes that have been foreclosed on, right? Okay. Mm-hmm. He didn't sell me the fast 4-plex that I bought, but the second one, he called me and said, "Hey, David, I have a townhome here in Arlington, Texas, that, hey, it was under contract. It fell through. But if you came in at the same price that they were, I'm sure you're going to get the deal." I looked up the deal. It looked pretty good. It was only in a very nice subdivision. End up buying it with a bank loan still. But the good thing is I bought it at, I think I bought it, sold it 6 months later for $30,000 profit. That was the most money that I ever got, right? From that, I did a 1031 exchange and bought, 3 houses where I'm putting 10,000 on each.
But how do you are you able to get a house for 10,000 at that time?
No, that would be the down payment.
Down payment,
right? Yeah, you get the loan on the rest. So assume the house was 100,000, 10%, Actually, it was 20%. So I was buying houses like 50 to something like that.
Okay.
But they were clean houses. This is houses that were financeable. You might need a carpet or something like that. But most of these houses were foreclosed houses that I was
Got
buying.
it. Got it. So you're
Now,
buying foreclosed houses. Okay. Got it.
yeah, that's before. Yeah, I would buy foreclosed house as a wholesale house. So I wasn't buying anything retail. That was one thing.
So was there a lot of competition for that foreclosed houses? Or was there like too much inventory?
I think there were not as many investors. Let me put it this way, as there are today.
Okay.
You know, I think I would go to a single family investor meetings, and I would be the only one probably in my 20s there. Most guys that were there were gray haired or, you know, been doing it 20, 30 years. You know, everything to them was expensive. You know, those are the same guys.
Because they have seen so low prices, right?
Yeah,
So,
because I talked to a guy back then and he was like, oh, I bought my first property 30 years ago and I paid 15 grand. Those houses were 15 grand back in the day. You know, you're buying 75,000 now. To me, you know, so those guys, you know, they were not paying that much more. And, you know, if they didn't get their price, they're not buying it.
yeah.
You know, over time, that's a change, of course.
That's a very interesting concept, right? When you have gone through that run up of price, you always think the latest price is very expensive, right? Like,
right. And we're running through that now. I mean,
yeah. Like I was seeing prices in Austin at $40,000 a door, like what, 3-4 years ago. And now it's all like 120, 130. So like, it's very hard for me to digest, to buy deals at 120, 130, because I could have bought it at 40, 50 a door, right?
we all wish we had bought it at those prices, right?
Yeah, which is crazy, right? So I think that's what happened in that meetup where everybody's gray out. But you are the young ones who are like, you can see the vision because you are just
I think I would
fresh.
count the guys that were my age group maybe with, you know, with one hand. I don't think it's even maybe a half fingers because maybe two or three guys, but everybody there was a veteran, or, you know, meaning in the real estate business, you know, where the brokers or they've been investing, they bought it in the 70s for 5,000 a door or something like that, you know. You know, nobody back then even talked about apartments or none of that stuff. It was just single family homes.
Okay, got it. So, so let's go back to 2006. You had 50 houses. And when did you start your first apartment deal?
So 2006, so I ended up doubling up. 2007, I bought a lot of houses as well. So we ended up going close to 60, 70
But 2007 is where the market crashed, right? 2008.
2008.
So did you buy the peak or were you okay?
No. Yeah, I guess you call it the peak back then. It's not where we are right now. Those houses, you know, I might have paid. I just have a house that I bought back then here, and I'm selling it today for $275,000. I paid $60,000.
Even at 2007, okay.
Yeah, I bought it in 2007.
So and this is in Dallas, right? So
yeah, right.
So basically, what has happened is maybe, I mean, taxes in general nothing happened during that time, I guess, right? Maybe the house crash is more on the coastal market.
Yeah, I do think a lot of people said, oh, we had a crash, but I think mostly whatever happened is, you know, I think that the values didn't go down as much.
Correct.
I think maybe they had a little bit higher, you know, higher vacancies or something like that. But I don't think as in Texas, in my opinion, and somebody else might have a different opinion, the values might have gone down. I mean, looking at it, assume I had a house that was 100,000, goes down 15,000, you know, 15%. So now you're at 85,000. Most of the time I'm buying them at 75% of value. So now I'm still in the money.
Got it.
So I didn't really lose anything. I kept the properties through the recession.
That's good. So let's go back to which year did you start the buying a first apartment?
So I started looking into multifamily in 2006, believe it or not.
2006,
There was a guy named David Lindahl out of Boston. He was
he was the first guru of multifamily, right?
Yeah, so I would go into his events and you know, but I would get nervous to pull the trigger, right? So I was like, I'll go in there and, you know, they talk all these big numbers and I'm like, man, this is way beyond my pay grade, you know?
Yeah, I know.
You know, I didn't think I could buy, you know, apartment complex, but the prices, even at that time, it's not the same price. They were still lower, but I couldn't see myself getting a loan of $1 million, $2 million to buy an apartment complex. Yeah. So I went to his events, bought everything, all the courses they were talking about, read it, and then just collected dust. I kept doing, you know, the easy thing that I knew how to do was single family homes. So I kept buying single family homes. The crash happened in 2008. I kept buying more single family homes. And in 2011, I had, all these single family homes. Maybe I had started paying them up. I had about 30 or 40 single family homes free and clear in 2008 when the crash hit. And so I bought my first apartment complex in 2011.
So coming back to Dave Lindahl course, right? Did he teach syndication at that time?
Yes, he was teaching
Okay.
syndication. But it wasn't, I mean, I think so all these other courses or investment groups around here, they might not appear, but I didn't hear when I didn't know about
No,
them.
they didn't. I don't think so. They existed. I mean, they all came later on. I mean, I know some people claim they are 30, 40 years, but they were doing small houses.
Right. So I did. Yeah, I didn't
Yeah.
hear about them. The only thing I knew was David Lindahl. He
Yeah,
was out there
yeah,
in Boston,
yeah,
and I
yeah.
didn't do anything with his course, to
Yeah,
be honest.
Dave Lindahl, I think if you go back to YouTube and look for Dave Lindahl in 2010, I saw one YouTube from him where he said, go and buy apartments in 2010. That's the best
Mhm.
investment in 2010. And he was like very adamant. And you cannot find any other clubs or any gurus out there who talks about apartment like what he did. So
Right.
I would say he probably pioneered, he had that really good vision of apartments even during that time, right? So even though
Yeah.
now, he's, I don't know what happened to him. I think the group still exists, but I think he's, I don't know, missing or what. But I think I'm just have so much respect for him because he's the only guy I can find in
Right.
2010 where he said everybody should buy apartment, buy this
So you were
asset class.
studying David Lindahl back in the
No.
2000s
I
as well?
recently looked up at some of
Okay.
his
Okay.
YouTube, right? Because I was looking at his YouTube and I saw that 2010 is when he was like really pushing for apartments and he was very strong about it and all that. So so you were doing a lot of foreclosure houses and you were doing 1031 exchange.
Mm-hmm.
How many units was your first apartment complex?
72 units.
So, and you said in 2008 is when you started looking at apartments, right?
I looked in 2006 when I got David Lindahl's course, but I never really, I studied it and I figured out this is too much. I don't think I can do it, right? So I let it collect dash and I went bought more houses, more duplexes, more fourplexes. And then after the crash, I would say, call it retired. I was, doing this full time. I started playing golf and I'm bored, right? And it's not like the calls are ringing every day. So I started playing golf and all that. And you meet people at the golf course. You meet people talk about apartments. You meet people talk about this and all that stuff. And then I was looking for a challenge, I was like, okay, the next thing is apartments are affordable now. So started looking for an apartment and, landed, somehow I ended up in LoopNet and found, there was a lot on foreclosure at the time. And that's how I was able to identify my first apartment complex.
Did you go for any meetups during that time? Where
No.
apartment? So it's
No.
not like nowadays where, there's so many meetups and so many.
I didn't do meetups. All I knew was, I knew is I got to buy the wholesale. Right.
Okay.
And I was tired about, I'm telling you, man, I live in DFW and DFW is wide. And I had a property in every city in DFW going from Johnson County, to, majority of all the counties and the surrounding counties, I had a house there. So I was driving from, it's a whole, you could drive a whole day to go check on the houses, right? I was getting tired of that. So I wanted something, kind of all together in one place. So that's what really I started thinking about apartments. That kind of.
Oh, because you were like tired of going around.
Yeah, because you have them all over the place, and if you have a maintenance guy, one thing goes wrong in one side of town, then he has to drive across town. It's just, it's just getting tiring.
Got it.
And then even for me too, because sometimes you have to drive to check on your properties, and I was really proud. I just go to my properties, just to go see if they're still there. But anyway, that's a joke, but I'll drive them and it was like take me I remember one time I got up early in the morning, didn't get home until 4. I'm driving from one part of town to the other one, just checking on the house. They were spread all over the place in the Metroplex.
Yeah, you must be proud of yourself because all that is owned by you, right? So
I don't know that was the case. I just felt good to know that I had the freedom from the job. Like I could get up and don't have to, rush. I didn't have to answer to anybody. It feels so good when you feel like, I don't have to answer to, the big boss.
Got it.
Just you feel like a big, my parents though were not very happy, or my mom wasn't very happy. You have this job at the bank, and what do you do? I didn't tell my parents what I was doing until probably about 4 or 5 years ago.
Oh, really?
I did
Well,
not
that was
tell.
one of the questions, right? Because you came from Kenya to the US, and I'm sure there are people back there, similar to me, my family, right? Everybody's proud of you.
Right.
So now you made it to the US and you have a good job, right? And what are you doing now? You're doing real estate? What is that?
I did real estate for 10, 12, 13, 14 years. Never. They still thought I was working at the bank.
Got it. They must be telling the whole village, hey, my son still work at the bank, right? Because that's what parents do, right?
And you know what? I had this thing on my Facebook page.
Uh-huh.
And see, because my parents, when I started Facebook, right, it was just so that I can communicate with my parents.
Oh, got
so
it.
What I would do is I left my job description there. I didn't change it because I didn't want my parents to be like, okay, he's a real estate investor. What the heck is this?
Were you in the suit and a tie and a bank backdrop?
Yeah, so I would never bring that topic up, but then I never changed what I do. I just left it as an accountant at the bank because
I also don't talk about it to my parents.
I never wanted to tell them what I was doing. But as long as I was still, they would see that I was taking care of business and all that. They didn't know where I was going. They thought, hey, this bank must be, paying him a lot of money.
That's true. So, so the first apartment complex, the 72 units, right? Because you are moving from single family to apartment, right. Valuation changes. Mm-hmm. Did you know what's the cap rate, how to calculate NOI and all that?
Well, I'll tell you, I didn't understand what the cap rates are, but I knew how to buy wholesales, right? The way I looked at deals, like, even today, if you buy a property, the property I bought, and I'll tell you about, was 10% occupied. So cap rate is out the door, how you calculate cap rate on that. So the way I looked at it myself at that first deal is, what is the best that can happen? What's your
downside risk, right?
Yeah, what is my downside risk? And I was like, okay, if I can live with the downside risk, then I was like, okay, what is the upside, on this deal? If I think I can live with the downside risk, and the upside risk is what buying it. That's how I looked at that first deal.
So you like to buy at discounts, I guess, right?
At that point, because it was like uncharted territory for me, right? So you're going there, making sure that, you try to de-risk the deal as much as you can. I was like, okay, what is my break-even point on this property? How many units do I have to lease it? Can it go to, it was, it couldn't go any lower than it was, but my break-even point was very low that I was like, okay, all I have to do is rent 20 units out of these 72 units, So the upside was huge, and that's what got me to jump in.
So I want to ask a theoretical question. So let's say you see a deal like today, where it's giving you 8% cash on cash or 8 to 10% cash on cash. It's beautiful, but it's giving you a good cash on cash. Would you buy that kind of deal?
Today, yes, and I'll tell you why. Because as an investor, you go through stages, right? You go with the stage where you're trying to build your equity and all that. And then you reach that preservation stage. So if it's a property, middle of the fairway, not, yield play, if I'm doing a 1031, right, parking the money there, it's giving me, it doesn't have a lot of headache, no, it doesn't require a lot of my time. That 8% return is better than what I'm getting at the bank.
Now, how if you syndicate the deal? You have investors hoping for that 8%. Would you still buy the deal?
Well, it depends on what my investor pool is, right? Because I'm sure I would have taken a pulse of the investors, but I'm talking from my standpoint. If I like the deal and it meets, I have to see what my reasoning for buying the deal, right? If it's a 1031 exchange that I have to park money somewhere.
Yeah.
I don't just look at that 8%. I look at the tax savings and all that stuff. So there's a lot that goes into it.
Yeah.
Um,
Yeah. 1031 makes sense because, you rather than paying to the government, you rather just put it into a
right,
property.
right. So yeah, would I buy 8%? I'll say it depends. Chances are I'll buy, based on what my situation is.
Okay, got it. So let's go back to your first apartment complex, the 10% occupied. Tell us about the story of that 10% occupied, and you were so daring to touch a property with a 10%
This is
occupied.
very interesting, right? Because, I know about apartments. I studied about it and all that stuff. Didn't know syndication, and I didn't know that I really wanted to do syndication. I had my single family homes. For all I know, I was set, right? Just waiting to pay off these houses and then I'll.
And how many houses you had at that time before buying the first apartment?
About 60, 70.
60, 70 houses.
2011,
And a lot of
yeah.
that is paid off, or
30, about 30, 40 were paid off.
so almost 50% is paid off
Almost
already.
50% was paid off.
Mm.
Yeah. So, like I said, I was looking for, something to do. And then I saw this on LookNet, called a broker, met him at the property. Actually, I had a partner that was actually, I won't say a partner. It was a guy that was working with me, trying to find houses. I drove to the property with him. We met the broker there. The guy was like, I'm not into multifamily. He didn't want to do multifamily, but he drove there with me, went and talked to the broker. The broker was like, by the way, I have 2 or 3 more properties. We go look at those. And for me, like I said, my criteria was, I want one that is affordable. So I got the one that was of the 3, there was a 200 plus unit. Well, I wasn't going to be able to buy that. They were asking 2.5 million at the time for 220 units in a very nice area. You look back, right? We should read about it. And then there was another one, was like 50 units, but they were asking a lot more than what they were asking for this one because of the occupancy. So then, I looked at it and I was like, you know what? This is closer to my my office, closer to my house, not too far. I would say closer to not my house, close to my office. And, talk to the broker, ask him, hey, what is it going to take to buy this property? And I think they were asking that it was on a receivership. So they had a loan of 2.1 million. They were foreclosing and the receiver was asking 695. So the bank was taking a big haircut on that property. And so I asked the broker, hey, what is the whisper price? I guess that's what you say now. And it was like, hey, to get on the best and final, you got to come in at around 675.
So did they even have a best and final for that kind of deal?
Well, they do. They had best and final. So what they do is at that price point, you had a lot of lookers, a lot of people wanting to buy, right?
Okay,
that's less than they listed for less than 10,000 a door, right?
And what was the normal price that time?
Well, I mean, it was right around that, maybe $1 million, whatever it is.
No, not for that deal. For every other property, how much?
Oh yeah, 15,000 maybe. Less than 20, around 20, you're paying a very nice property in a very good area.
Okay, so 20 is the market rate.
25, yeah.
So 10,000 is this 10% occupied property, right?
Yeah, 10% occupied property, paying around $10,000. So I look at it and I was like, okay, this one would work for me because of the fact that, hey, didn't take very much for it to break even. So that's how I looked at it that way. So I, called the broker, met the broker, ended up putting the offer for 675, which is what he told me it was going to take for me to be in best and final, right? So I put the offer in, give him 25,000 honest money, and that was, gave it to the title company, 25,000 honest money, and that was it, right? 2 weeks later, he calls me and says, you're in the best and final, right? And then, but let me go back a little bit. But during those 2 weeks, I'm talking to everybody and anybody, whether they've done property, they've ever bought property. What do you think about this area? What do you think about this apartment? Everyone was telling me, don't walk, run from that property. Do not buy it. Even the city people told me, don't buy it. I asked them.
And what was their reasoning? What was their reasoning? Don't buy.
They were just saying, oh, that's kind of a tough area. If you want to buy property, go to the north part of the city. You need to go buy in this. You get advices from a lot of people that were not never bought property. So when best and final came, I was determined to get out of the deal. So I told the broker, hey, I go, my best price is going to be 475. which is $200,000 below what he was
So
asking.
you're the first guy in all of the best and final where you reduce when you go further
I
into the
reduced
best.
my price, and basically what I'm saying is I went out.
Yeah.
And he was like, basically was like, hey, best and final means you go up on price. I was like, I know, but this is my price. And he was like, are you sure? And I was like, yeah. So it's like, okay. A couple of days, a week later, calls me and says, you got the deal.
Maybe you should have put lower.
You can think about that. That crossed my mind, right? I was like, what happened? So anyway.
What happened?
So I called him and I was like, listen, Mr. Broker, I don't know if you understand this, but I don't want the deal. When I went down, I don't want the deal. And it was like, hey, there's nobody, buddy.
There's nobody else.
There's nobody, buddy. You need to, your honest money is gone.
Okay.
So I'm like, okay, now what? Your 25 grand is gone. It went hard after we went to best and final. And so I was like, okay, so what do I do? So I talked to the broker. That's actually one of the things that I like about, real estate investing, right? Your broker could be a very good resource, for things. So this broker helped me get a bank to solve my situation. So he was like, okay, I've heard your story. I know your story. I need you to drive to such and such a bank, tell them your story, and tell them you have this property under contract. So I drove to a bank that he told me he was actually has a relationship there, right? I think he was part owners. I don't know if he has some ownership there. Yeah, there was some kind of relationship with the bank. So I drove there, met the president of the bank, told him my story. President of the bank told me, David, I will not tie this property with a 10-foot pole, but I'll tell you what I can do. I'll take about 8 of your houses. I think it took 6 of your houses. I'll give you cash. I'll give you $500,000. You can pay cash for that property, but I'll put a lien on your 6 houses.
Single family. Okay, so you basically give you a credit line, I guess, right?
They put loans on it, so basically they cashed it out. They cashed
Okay.
it out and gave me, and back then they were doing like maybe 60% LTVs, but I didn't care on those single family homes. So he gave me the cash, bought that complex. But one thing before I even proceeded is, remember, I never managed the property, didn't deal with property management companies and all that. I went and talked to the manager of the property that was employed by the bank, the receiver. So she was the property manager there. So I asked her, hey, the manager, I asked her, hey, what is it going to take for you to stay on?
Okay.
And she told me, this is what I'm making. If you give me $1 raise, this property is not too far from my house, my kids' school and all that stuff. If you give me $1 raise, I'll stay on board with you and I can turn on this property. Actually, she let me go take a peek at the units. I'll sneak in, drive by there, and I'll tell her, hey, show me some units. You show me units and tell me this property is not as bad as they seem to be. The bank doesn't want us to lease any units. They don't want that liability.
Got it.
So anyway, so I told her, hey, what about $2? What about $3? So I ended up saying $3 because I was freaked out. I wanted her to stay.
Yeah, and she's like, you did not know anything about apartment at that time.
Property, I didn't know what I was going to do at that point. I kind of have an idea, but you need somebody at the property. I didn't know how I was going to hire my first employee. What am I going to do and all that stuff. So I gave her a $3 raise, and it was the best $3 that I ever spent. Because she ended up hiring a maintenance guy, because she had experience, right, from property management. She had done property management for a while, so she knows people that do maintenance. So she brought the maintenance person, and the rest is history. 6 months later, the property was 90% occupied.
Within 6 months, wow.
Within 6 months, like there was not a lot that needed to be done in a lot of the units.
Got it.
So we just went in there. I think we spent like $500,000, but a lot of it was, carpet paint, and you get people in. So we got it, did it. After 13 months, we exited and did very well on that property, and 1031 exchange into a second property, which we paid cash.
So you sold off that property, or
the first property after 13 months?
After 13 months, you sold it off, I guess.
We sold it, and then we did a 1031 exchange.
Was it easy to find a buyer for that property at that time?
Actually, we had like 12 offers.
Okay.
And one of them was cash.
Mm. So it's
And
not like a property that nobody touches, right? It's like
oh
it's
no,
just
no, no,
10%
no.
occupied and there's no financials and you
Yeah,
don't want to touch.
yeah.
Okay.
So at the beginning, yes, but now you have 12 months of financials.
Mm. So I think your thought of what is my downside risk helped you, I think, right? Because you looked at
Yes,
risk versus reward, and you took that risk, right?
right.
You're one guy who took the risk, but nobody else want to take the risk, right? Kind of thing.
Actually, the guy, remember I told you there was a partner that was going to
Yeah.
invest me at the beginning that, took off when we went to the property and everybody was
Did he
telling us
cry
run.
after that?
When I showed him the check of $1 million when we sell the property, I mean, the guy was like, I think, he wish he got in. Let's put it that way.
Yeah. That's true. That's true. It's always a hindsight 2020, right? So,
All right.
what's the reason you didn't look for a third-party property management for that 10% property?
The property wasn't, 2011, there were not a lot of property management companies. A lot of property management companies that I knew at the time did single family homes, right?
Oh, got it.
There was not a lot, unless you have all these, back then there was not a lot of there was not a lot of property management companies that managed Class C properties.
Got it. So who manages most of the
So you
Class
go
C
to Lincoln
properties?
and all that, they're not going to take that property
Got
at
it.
10%. So yeah, so you had to, I think it's by default we got into, started doing the property management on.
Got it. So you made a lot of money from that one deal, the 72 units.
Right.
What property did you buy next?
193 units.
Okay, so after that, what did you buy after that?
After that, I bought 3 apartment complexes. I bought 100 unit, 124 unit, and 144 units.
So what was the period from that one property to the 3 property? How long was that? How many years was it?
About 4 years.
So was it propelled by your single family equity? You're trying to sell single family, or did you roll the equity from the first deal?
So I thought both. So every time I got a delayed up from a bank or that I don't make sense, I'll leverage my single family homes. And I think when I started leveraging the single family homes, that's when I multiplied like crazy, because now you could take, I think I went after that, I met a bank that went and gave me $1 million line of credit on my single family homes.
Got it.
So when they gave me that line of credit, that was down payment that I was using to buy, apartments.
And what year was this? Is it 2009, 2010, 11, 12?
Oh, no. This is 2012, 14,
okay.
And 13 and all that.
So did you hear about syndication or, big groups
I
buying
did.
apartments?
I did. I think I started hearing about syndication around 2013. 2013 about syndication. I went to the syndication. But for me, I grew up thinking partnership were bad. People that I talked to, they never had good experience with partnerships, right? And I wasn't looking to be this big, I wasn't looking to be, Donald Trump, right? I wasn't looking to be like this real estate tycoon. I was looking to, hey, I needed to set a lifestyle, and that's what I was, I didn't think that I needed to buy 10,000 units. I didn't think I was going to be buying 1,000 units. That was not in my vocabulary.
So your single family is the main engine, I would say, because you bought it in the beginning and you had so much equity, and you build that equity, and that has helped you to buy a lot of apartments.
Yes, I think I'll say single family was my base.
Yeah, your base.
I built that base, and then I'll go back to it and leverage it to either sometimes through selling it or refinancing it or whatever it is, cross-collateralizing it at some point, and then selling it and buying an apartment complex. So every time I would sell a single family home, I would buy a big. I remember about a year ago, I sold single family homes and was able to get enough down payment. The price was a lot higher, but I was able to get almost enough down payment to buy a 100-unit complex.
Wow, that's cool.
So I sold a couple single family homes.
So I think the single family helped, which is even for me too, right? I had like 13 single family, and that was my base to buy my first 45 units, right? Even though I syndicated it, but I did quite a good down payment for that. So that's good. So you basically, from there, you just keep on buying and and you had like almost 4,000 units. You sold like 1,500 units right
Right.
now, right? And why did you sell?
To harvest the equity. So now it's like, when you're doing 1031 exchange, nothing is really going in your pocket, right? You're still house rich and cash poor. So I wanted to get some liquidity. You'd own all these properties, and then you look at your bank account and you're like, you
Right.
have enough just, to cover to cover expenses. And if there was any emergencies and all that, but it wasn't, I wanted to, kind of get that, take out, kind of asset allocate, get some cash.
Got it. How big is your company right now? How many staff do you have?
We have, I think last time I checked was 75. We have probably more than that now, but I think we're about 75 last time I checked.
Okay. Yeah. When you get too big, you forget about number of employees. That's okay. It's forgiven.
It's not that much. Yeah, but
because you have to delegate some of it, right?
Yeah, you have to delegate. And that's one thing that I'm learning to do that I didn't do at the beginning. I wish I learned early.
Yeah.
Was to delegate, but like you did everything, and now I'm learning to, let it go.
Got it. Yeah, I mean, and also property management is the employees keep on moving, right?
Oh yeah, there's a lot of
many movements,
turnover.
Right? A lot of turnover, and
Yeah.
Sometimes our job is just hiring.
Yeah. I'll say this is not the best way to put it. Sometimes I feel like, I talk to my HR person, and she's like, I feel like I'm an adult daycare.
Yeah.
Because sometimes, employees, but they're great people though. I love them.
Yeah. They're really, I mean, we usually say adult daycare because we own the apartment and we take care of the resident, right?
Right. But they do take care of the residents. So I kind of, that comes with the territory too.
Yeah.
But yeah, like you said, I like managing the employees more than managing the apartment. So it's not like people say you self-manage, but are you really, you're managing the employees that actually do the managing.
The managing of the apartment,
Yeah.
right? So, that's very exciting to hear your full story, because I think one main thing that I see is, sometimes people say there's no deals here or deals are too expensive, right? But as you said, it's always about, when you have to take the effort right now. I mean,
the way I look at it is, how you do stocks, right? You do dollar cost averaging. So the way I look at it is, don't ever time the market. You can, but I would say don't time. If one guy that ever told me something before, it was like, what? There's always deals when the market is going up, and there's deals when the market is going down. You've got to be in the field to play. You have to be in the field in order to score. You can't just be in the, on the stand,
the sideline, right?
On the sidelines, and assume that you're gonna win a game. So you have to be always playing.
Got it.
And that's my philosophy.
So 2018, 2019, 2020, did you buy any deals?
I think the last deal that I bought, we bought deals last year. We just bought deals early this year.
So don't you think that was too pricey? Because now you have seen that entire run up, right? From 10,000 a door now to...
That's the disadvantage, right? Like when you get that price points back in 2011, it's like I know people that stopped buying in 2014, 2015, around that time, because they thought 50,000 a door was crazy, right? Because
people stopped buying. You mean people stopped buying?
Yeah, I remember even my first bank that I went to, I paid, less than 10,000 on the first apartment complex, right? My second one, or my third one, fourth one, I remember down there, because I remember the conversation with them, was like 32, 33 a door. They're like, David, why are you paying this much for this apartment complex? You pay 15, 20, why 32,000 a door? That unit right now, I saw it's being listed for 95 a door.
Wow, that's crazy, right? So it's real estate. I mean, it's
different market. Yeah.
Different market. I mean, but that's a disadvantage, right? Because a lot of times you see 85, 90 a door, you say, oh, no, that's too much kind of thing, right? Because you're so used to seeing and you're so used to pride yourself too, I guess, right? Because you bought it at a really good price, and now it's like...
Yeah, but you know what? I wish if you ask me one thing is, I would have bought a lot more than I bought, right? Everybody says
it's a hindsight 2020, right? I mean, if the market have crashed, people say I should have sold more, right? So,
yeah, exactly.
Right. So So let me ask you one question, which I've never asked any other guests, right? So I was telling you before the show, you're going to get one new question, which I didn't ask anyone else. So let's say you are given the biggest banner on the highway of the world, right? So everybody in the world is going to drive through this highway and they're going to see your banner, right? So what would you want to put on that banner? What's the message that you want to tell the world?
As far as the company, as far as what we do?
No, not about business, about your personal message to the world. What do you want to say to the world? I mean, what's your message? Is there a message that you want to communicate to anyone out there?
I say take action.
Take action. Okay.
Yeah, I'll say take action in whatever you're doing. You know, I think action cures a lot of things.
Don't procrastinate, right? Because I've seen a lot of people procrastinate, right? So,
yeah.
Got it. All right, David, why not you tell our audience about yourself and in terms of where to get hold of you, your website, your company, and how to get in touch with you.
Well, I mean, I think the best way to get hold of me is through my email. My email address is david@bellasrealtygroup.com.
So Bellas is BELLAS, right? Bellas
Realtygroup.com spelled out.
Okay.
Or my phone number, office number is 817-284-2445.
Okay. Awesome. All right. Thank you very much for coming on the show. I really enjoyed it. I'm sure a lot of our audience and listeners is inspired by your story, and many are going to take action, and I'm happy for them and happy that you came and give the message to everyone, because I think it's a lot of times they need to see people who have struggled in life and came up in life and build that puzzle to own as many units, 4,000 units as what you have. So it's not impossible, right? And not even with syndication, right? So that's important. Right. So awesome. All right. Thank you very much.
Well, thank you. Thank you for having me, James. I know it's been a long time coming, but here we are.
Absolutely.
We can cross it off the checklist.
Checklist, yeah. You already did my podcast.
Yeah, I did your podcast.
All right. Thank you.
Thank you, James.
That's it for this episode. If you'd like to learn even more, check out James's free audiobook. It's the audio version of his best-selling book on passive investing. You can get the audiobook completely free, along with other valuable resources, by visiting www.achieveinvestmentgroup.com/free audiobook. Also, be sure to join our Facebook group too. To find it, just do a Facebook search for Multifamily Investors Group. Thanks for listening. Join us again for another episode next week. See you then.